behavior associated with manias and speculative bubbles, and the persistent behavior associated with long-shot betting events, such as lotteries, where expected value can be negative. In the venture capital context, long-tail investing denotes a systematic approach to the deployment of risk capital into entrepreneurial ventures by intermediaries who attempt to use their domain expertise to generate large returns. In a world of perfect information and efficient markets, economic theory suggests intermediaries should be absent. The fact that venture capitalists do exist is arguably because they are able to maintain informational advantages in the selection and governance of startup investments. Another interpretation is that they function merely as capital conduits and organizers, but do not particularly add value in terms of startup outcomes. Long-tail returns have always been difficult to generate, and the VC industry has sometimes been chaotic and subject to the destructive ebbs and flows of investment cycles. History shows, however, that the social benefits of venture capital have been immense. By facilitating the financing of radical new technologies, U.S. venture capitalists have supported a large range of high-tech firms whose products, from semiconductors to recombinant insulin, telecommunications inventions, and search engines, have revolutionized the way we work, live, and produce. While technological change can often disrupt labor markets and increase wage inequality, in the long run, innovation is essential to productivity gains and economic growth. The venture capital industry has been a powerful driver of innovation, helping to sustain economic development and U.S. competitiveness. Given the importance of the United States to the history of venture capital, this book adopts a U.S.-centric focus. Yet the book's analysis could begin with a context more deeply historical and global. Early on, the need to divide financial payoffs from joint pursuits led mankind to establish rules and norms akin to those used in the modern venture capital industry. Some of the classical civilizations of the Mediterranean were characterized by stable, highly profitable, and well-developed systems of commercial enterprise. While markets were frequently rudimentary in both scale and scope, transactions could extend beyond familial ties to arm's-length exchanges between investors and traveling merchants. Medieval Venice was strikingly modern in terms of its contracting traditions, and it could be argued that the Venetians acted very much like venture capitalists in their operation of risky trading voyages. A milieu of institutions and cultural norms facilitated the expansion of enterprise through commercial ventures. It was in the United States, however, that structure and contracting became embedded into capitalism through the provision of finance for entrepreneurship. As a way of organizing the narrative, this book identifies four main stages in the history of venture capital from the 19th century up to the early 21st century. These chronological stages are not always cleanly distinct from one another, and the allure of long-tail investing is the theme that runs through them all. The stages reflect the development of some of the most important financial institutions and practices which were then carried forward. Over time, the VC function of providing capital to startups evolved from being conducted by collections of wealthy individuals to being the work of specialized firms. Enabled by the challenging cultural and regulatory environment in the United States, the VC industry expanded to large scale and became increasingly impactful in the sphere of entrepreneurial finance. The first stage saw early investors deploying risk capital into high-risk and potentially high-reward activities in ways that established historic precedents for VC-style investing. Chapter 1 focuses on risk capital deployment in the New England whaling industry, which has especially striking parallels with modern VC in terms of organization, payoffs, and more. Whaling was one of the largest and most important industries in America during the early 19th century. In it, New England whaling agents looked a lot like modern venture capitalists. There were wealthy individuals able to supply finance, and there were captains and crew willing to initiate and manage voyages, and whaling agents intermediated between the two groups in much the same way that today's venture capitalists intermediate between entities like pension funds that supply risk capital and entrepreneurs capable of applying that capital to profit-making opportunities. Like venture capitalists, whaling agents charged fees and received a share of the profits in return for intermediation. They engaged in repeat business with the best captains. They sometimes syndicated to spread risk.